My name's John Ross from Finance on a Budget. In this video, we'll go over the various steps of inheriting a house and the various tax implications of doing it prematurely. There are many different ways to inherit property and pay lots of taxes, but there are actually ways of doing it that significantly lower your tax burdens. By the end of this video, you will know how to successfully take control of property and minimize the amount you're going to owe to the government. Be sure to give this video a like, subscribe, and ring the notification bell. What are the tax implications of controlling a house before death? If you're like me, you may be thinking that you want to take control of your parents' assets right now, even if you're not legally bound to do so. This can lead to a lot of tax obligations for you. In the same way, giving away your assets to your children while you're still living just gives a hefty tax burden to them. If you think transferring assets now will keep the court from controlling assets once a parent becomes incapacitated and avoid probate, remember that giving someone other than your spouse more than $14,000 in a year entails a gift tax. If you were to sell your parent's asset, you will be slapped with a hefty capital gains tax. This is because you didn't really receive the asset as an inheritance upon death, so there are no shortcuts here. For example, if your parents bought a house for $100,000 or even less many years ago, and it appreciates to $350,000 today, you might think that you can sell it for $350,000. But because the title was transferred while your parents were still alive, the house will keep your parents' original cost basis of $100,000. Which means a $250,000 gain on the sale. You will then need to pay at least $50,000 in capital gains tax. Yes, I said $50,000. You might also have to pay an additional 3.8% net investment income tax, depending on your other income and filing status. On the flip side, if you get a house as an inheritance instead of a gift, then you will receive a new stepped-up basis in the market value, which looks at the date of death of your parents. Let's say that your current market rate upon death is $350,000. When you sell the house for $350,000, there are no gains, so no capital gains tax either. Pretty big difference, right? Do I have to pay tax on a house that I inherited? There is no federal inheritance tax, so most of the time you won't have an immediate tax liability after inheriting property. Still, financial and legal responsibilities depend on a variety of things, like existing debt obligations you may have, such as the mortgage. You'll also need to consider the current condition of the property as well as how much it's going to cost you to spend on upkeep and maintenance. Normally, a lot of mortgages can be assumed by the heirs, so you can take over any payments or remaining payments based on the terms of the original loan. However, for reverse mortgages, the unpaid balance will be due on sale or when the mortgagor passes away. This means that the heirs are now required to sell the property in order to settle the debt. The moral of the story is to avoid reverse mortgages at all costs. While I understand that elderly can see this as a way to make ends meet when Social Security just isn't enough, but the banks will always screw over their customers in the end. Banks are evil. Don't give them your money. What to do with the inherited property? Obviously, you need to check on the condition of the house. If it's going to cost you a huge amount of money just to improve a house that hasn't been maintained, then you might want to consider selling the house instead of repairing it and keeping it for yourself. If you share ownership of the inherited house with siblings, it's important to get everyone's opinion on the matter to avoid complications. If you decide to sell the house, you may need to pay short-term or long-term capital gains taxes if you profited on the sale of the property based on the current market values at the time of death. If you decide to move into the house, you can make use of the capital gains exclusion in future once you decide to sell it later down the road. For now, you'll need to repay any debt, taxes, and property insurance if you've moved in. There's always the option of renting the home, but you need to be sure that you know how to run a business as a landlord and that you have experience with real estate at the very least. For me personally, I was a landlord 3 times. My first was uneventful. The second had 2 tenants that stopped paying the rent and eventually went into foreclosure. The third was filled with melodrama that had one of the 3 tenants dropping water-absorbing balls down the drain, leaving me a big mess to clean up, and eventually damaging the water heater, causing massive damage to the basement. So, no, I'm not big on being a landlord. I'll cover that in a future video. What if you're the current owner of the property? If you're the original homeowner, you have lots of options for pre-death transfers, like selling your home to the children. Doing so means that you can sell the property to your heirs at fair market value, because of a bargain sale will mean that the property can be considered a gift, which will generate tax implications. Giving your property away, on the other hand, is better done through a revocable living trust so that you have the option of changing your mind in the future. Also, gifting a property will trigger a due on sale clause where you will be required to pay the mortgage in full right away. Also, if your heir gets to financial trouble at any point, the property could actually be foreclosed on in a bankruptcy, so you could always run that risk. Gifting the property deed to the children does nothing to transfer the debt of the mortgage. Parents must either keep paying the mortgage or have the children refinance the loan in their own names. But as I already mentioned, this is likely a bad idea. Depending on your state, you can also do a deed transfer, which works like a payable on death designation for your bank account. You can use this to transfer assets with the added flexibility of being able to change designations at any time while avoiding probate at the same time. Transferring ownership before death lets you pass the land without the probate process. Plus, it can also help you qualify for Medicaid while avoiding the Medicaid estate recovery program in the future. However, you need to remember that once the property is deeded, you no longer have any control over the property. You can't take back that transfer either, nor can you avoid potential negative tax consequences related to capital gains taxes. Because you passed on the property before death, the heirs can't receive a step-up basis for the capital gains tax purposes. Of course, there's also more. There's this thing called Medicaid transfer penalty, which is triggered when you transfer property for less than fair market value within the last 5 years, rendering you ineligible to qualify for Medicaid for a period of time. I tried to keep this video short, but there's a lot to unpack here. There are definitely pros and cons to the various ways of approaching this, so it's best to discuss the matters with a tax consultant and your family members before making any important decisions. Be sure to give this video a like, subscribe, and ring that notification bell. Thanks for watching.